Everybody, and thank you for joining us for this lunch presentation on exporting to the U.S. 101. If you're selling into the U.S. or starting your plan for exporting in 2024, you're in the right spot. Today, we will review the various things to consider when selling into the U.S. as a Canadian company, either through your website, sales reps, Amazon, or other fulfillment services. I'm Carolyn Powell, Development Director here at Tronconi Seguer & Associates, and I'll be your host today. A couple of ways you can engage with us. There is the toolbar, most likely on the right-hand side of your screen. There is a questions section. You can go in there and ask a question throughout the presentation, and we'll get it answered for you. And we'll also leave time at the end for questions. There is a handout section. We have a couple things in there for you. Today's presentation is in there. The bios of both our experts and the Wayfair charts that Tom will be referring to later in the presentation. After today's presentation, you will receive an automated survey on the presentation to see if you had any further questions, if you wanted to set up a meeting with Tom or David and give us any feedback. Later this afternoon, I will send you an email with a recording of the presentation, again, another copy of the handouts, and if you want to go back and listen to anything or share it with somebody that was unable to attend. So without further ado, we are going to get started. Tronconi Seguer & Associates is a certified public accounting and consulting firm. David Lever is a CPA and partner here at the firm with over 16 years in public accounting. David is part of our tax department and focuses on foreign-owned companies doing business in the U.S. and if they have facilities in the U.S. or just doing business on the side. He understands the complexities of being a foreign owner and the business differences between the countries. Tom Mazurek is also a CPA and partner and has over 25 years in public accounting. He is also in the tax department and focuses on sales tax, income tax, and state tax. His clients have sales throughout the U.S. and thus have filing requirements in many of those states that they're doing business. So I'm going to hand this over to David to get us started.
Thank you, Carolyn, and good afternoon. There's a bit of information, a lot of information for us to go over in a short period of time, so we'll do our best to provide it in a clear, concise way and hopefully get your mind thinking about what might be next for you and your company. So typically, companies are looking to expand into the U.S. Would do so in three different ways. The first being possibly testing the waters and operating as a U.S. branch, which we'll talk a little bit about today. The other being creating a U.S.-based subsidiary entity, so forming a U.S. entity and all that goes with that. And the third is acquiring a U.S.-based business. I know we've had separate webinars on some of those other topics, and we'll have some more upcoming as well. No matter really which of the three that you choose, it's really important for your business to really go through and develop your business plan, your export plan, to answer the who's and the who's, the where's, why. I usually call it, the typical 5 W's and the how. It's really to identify who your customers are, what your flow of goods or products or services will be to the U.S. and all about how that's going to happen, along with the flow of funds as well. Usually having those details down on paper in advance really would then help us to devise the right strategy for you and your company. And you can take that in a short-term, medium-term, long-term basis as well. And then getting local professional advice is paramount as well. So oftentimes we'll be working with your Canadian accountant, a U.S. attorney, and possibly also a Canadian attorney as well. Again, to make sure that anything that we're choosing to do for you and your business on this side of the border makes sense for you on a global basis. So today we're going to mostly talk about whether your company is already exporting into the US through your existing Canadian business, or whether you're really considering testing the waters and coming to the US. We're going to talk about the federal state issues that go along with that. So from a federal tax perspective, foreign persons that are doing business in the US are subject to US federal income tax under statutory laws if the activity is effectively connected with the conduct of a US trade or business. So you don't necessarily have to have a physical place of business. Selling into the US can constitute that. Sending personnel into the US can do that, again, under our statutory laws. The US-Canada tax treaty is pretty robust and wonderful, obviously with the proximity of our two countries and how the trade goes back and forth. There's quite a bit of detail in that treaty, and the purpose of the treaty, again, is to make it easier for companies on both sides of the border to do business with the other country, but also to eliminate double taxation. So when we're trying to, so even if your company is doing business under our statutory laws in the US, we would then look to the treaty to determine whether your company has what we call a permanent establishment in the US. So that really means, are you operating a business in the US? Are you subject to is your business subject to US taxation? So under this article of the tax treaty, in talking about this fixed place of business, this can take the form of a lot of different things. So obviously, so if you have an office, a branch, factory, workshop, place of management, any of those things physically, that we think of, those can all constitute a fixed place of business. Also, if you are working in the construction area, on a building site, or installation project, if that project lasts more than 12 months for your company, that can also constitute a permanent establishment. Interestingly, the way that is measured is from the time that your business first starts on the construction site. So if you're a subcontractor, and say you start in January, and then you don't get called back again until July, and the project continues on past the next January into the following year, that point in time where you first start work on that job is when the clock starts. So it's important to, that we're able to track those things, and we work with you to help figure that out. The next bullet point here about dependent agents they have authority to sign contracts on behalf of the U.S. business. This part of the treaty, you really think really goes back to more what you might think of it kind of more antiquated, in that you're not going to really, who's really down here signing contracts on behalf of business. Usually, it's done electronically these days, but really it's who has the ability to bind the company. And so, if you're sending salespeople into the U.S. or you have others that are here going to trade shows and other things like that, if the orders are going back to the head office in Ontario or somewhere else in Canada, and that and headquarters really has to approve and enter into the contracts legally, then generally you're not creating a permanent establishment for your business. In a case of smaller businesses, or in cases where executives from a Canadian business want to move to the U.S., that can become kind of difficult, because those roles and responsibilities of those individuals, or if they're a smaller business and there aren't too many decision makers in the business, you could be binding the company from the U.S., even though it's maybe not intended to be like that. So it's definitely something, again, where the who and the where is definitely important. And so oftentimes we can work with you to maybe change the roles and responsibilities of officers if need be. Providing services, so service providers in the U.S. for 183 days or more in a 12-month period. And so under this subsection of the treaty, if your company is sending workers to the U.S. for 183 days or more, so if you send in 10 employees to the US all on the same day, that's 1 day for this purpose. But if you're sending employees here on 10 different days, that is 10 days for your business, even if it's just 1 employee per day. So it's really important to be able to track those things. It is a 12-month rolling period for the business as well. And during that period, more than 50% of the business revenues were derived from services performed in the US. I'm not going to get into the details on this further, but the article does, or the treaty does spell out articles for connected projects as well. So if you have more than 1 contract in the US and you're providing services, those can be connected depending on geography and related customers. P does not include the use of facilities for storage, display. So if you have inventory in the US in a warehouse, that in of itself does not give you a permanent establishment. If you did, if you had if you rented that facility or own that facility, that would constitute a physical place of business. And all these other items under here, maintenance of stock and goods, or processing by another person. I think these are all things that are pretty much speaking towards 3PLs or warehousing. So those things in of itself for federal tax purposes do not necessarily give your business a fixed place of business or permanent establishment in the US. We're going to talk about it a little bit later that might not be the same answer for you with the state that you might be doing business in. Advertising, supplying information, scientific research, and other things that are preparatory or auxiliary character. Those things, again, do not create a permanent establishment for your business. So what do we do? What do we do if that's the case? So you may be, in a lot of cases, and when we speak with companies that are looking to move to the US or expand their business to the US, we're talking about their plans going forward, and then oftentimes we talk about, well, where's your business at right now? 9 times out of 10, that company is already selling into the US and may have some of these other issues that may be longstanding and they've just never been addressed. So if your company is creating that or operating that trade or business in the US but is protected under the tax treaty, there are some things that we can do to protect your company. We can file what's called a treaty-based tax return. So your company would get a tax number with the IRS and an employer identification number, and would file an annual tax return. And that tax return wouldn't compute any tax that's due. It would say, for better lack of terms, IRS, I'm ABC company, I am here, I'm selling into the US, or I'm sending people into the US for less than 183 days, or whatever facts and circumstances may be related to your business. But IRS, under the US-Canada tax treaty, we would cite the relevant articles and subparagraphs. I don't have a permanent establishment of the tax treaty, so IRS, you cannot tax me. So we would file that every year, and that would protect your company. There was a court case, US tax court case for about 3 or 4 years ago now, called Adams versus the Commissioner. And this was a situation where Adams was a UK company that was operating a vessel off the Gulf of Mexico and generated some significant revenues. It filed treaty returns for 3 years, 2011 to 2013, but did not file in 2009, 2010. The IRS identified Adams as a non-filer, a potential non-filer, and obtained information that said that the time that they spent off the coast of Florida was in fact a permanent establishment for 2009 and 2010. So the IRS assessed tax based solely on the revenues, did not allow the company any deductions. And so this went through various levels of tax court, and the tax court found that they did have a permanent establishment in the US for those years. But the kicker here really was that because they never filed anything for 2009, 2010, the IRS was allowed to disallow any potential deductions. So this was a strict tax assessment based on revenues, which is probably the worst thing you could pretty much possibly have. And that was merely because the company had never filed anything. So the statute of limitations the 3-year statute of limitations hadn't started, and because they had never filed, it was past the statutory time that you could take deductions. So that's why oftentimes it may seem like a nuisance, and a lot of companies we talk to that have been selling to the U.S. for a while really say, well, I've never done this before. Why do I have to start doing this now? Again, this is something that is really protective for the company. Kind of belt and suspenders approach that we usually employ. The company does have a permanent establishment. It should file a tax return as well. So it will file an 1120F foreign corporation tax return for doing business in the U.S. And we will report what's considered to be that permanent establishment of that branch. So it's not, oftentimes I try to think of it as a division of the company. So we would look at, okay, well, what revenues and what expenses are related to that specific activity that's occurring in the U.S. creating the permanent establishment. And then we'd also look to see what expenses that we could allocate as well that might be in support of that activity. And the company would pay corporate income tax at 21% currently, and file that within 3.5 months of the year end. The company should receive a foreign tax credit in Canada for any taxes that are paid to the U.S. The other thing that is not on the slide that we often think about is the concept of branch profits tax. So the corporate tax system is similar to, in the U.S., similar to Canada, where there's 2 layers of tax on the business. The first on the profits, the second on the dividend or distribution. When it's a case of a foreign company doing business in the U.S., if the entity doesn't reinvest those funds into the U.S., into the activity, that's a deemed dividend. And under the U.S.-Canada tax treaty, there would be a 5% branch profits tax. So we would do this measurement every year to say, okay, well, what happened to the profits from that year? Were they reinvested in the business, or were they taken back to Canada? If they were taken back to Canada, that 5% additional branch profits tax would apply. The other nice thing under the U.S.-Canada tax treaty is that there is a lifetime $500,000 profits exclusion. So the first $500,000 profits in the U.S. Would not be subject to that additional 5% tax. So that's one reason why, depending on your business plan, you may want to consider starting your business in the U.S. through operating through a branch, because you can, without having to create extra legal entities and all the things that go along with that, have a little more permanent structure. You can test the waters in the U.S. to see if your product or service is something that is going to take and may have some staying power. And you can do so. We do see it often where a company will start operating through their Canadian business, and then eventually, when they get a kind of a critical mass of business in the U.S. or have another reason, that they will then form their own U.S. subsidiary. Right? As a result of this exercise, as I was discussing on the initial slides, there's often a lot of thought and planning that goes into this. So, not just mapping out where and how your business will work, but other questions may come up. Should the company, create that U.S. business entity? There's a lot of different reasons for that. How will we get the money back to Canada? And a big one that often kind of drives the conversation is, who is coming to the U.S.? Will Canadian employees be coming to the U.S.? Oftentimes we see that, rendering services or specialized knowledge or setting up your U.S. business. Oftentimes there's a transfer of information and training and those types of things like that. And that can cause some issues potentially for your business if you're sending Canadian employees to the U.S. So now we're going to shift a little bit to state and local income taxes, and then I'm going to turn it over to Tom, who's going to talk about sales tax. So you can probably just take a lot of what I just told you for the last 15 or 20 minutes and throw it out the window when it comes to the states. So we often say that doing business in the U.S. is like doing business with 51 different countries, because you have the IRS and the federal government and the 50 states. I probably just stole that one from Tom.
Yes, you did.
So as outlined here on the slides, the tax treaty is a tax treaty only between Canada and the federal government, the IRS. So the states are not bound by that. They have their own autonomy to tax business within their own borders, and they've gone to quite great lengths to define what that is recently, especially. And so we often need to evaluate on a state-by-state basis whether a foreign company that's doing business in the U.S. would be able to get protection under the tax treaty. And Tom's going to talk about nexus, or whether they're considered to be doing business within those borders and getting those protections that would be afforded potentially to a U.S. business doing the same thing. Also important to note, if a company is doing business in the U.S. and protected under the treaty, there still may be some other obligations with the states. So they may have gross receipts taxes, sales and use taxes, which Tom was going to talk about, potentially property taxes, and payroll taxes, depending on what the activities of the business are. So I have quite a few clients who file a treaty-based tax return that I talked about in the U.S., then they file in 5, 6, 10 states. And it's because they do have activities that meet this nexus threshold, which Tom is going to talk about, but those states don't necessarily recognize protections, whether it be under a federal law that we have that Tom's also going to talk about, or whether it be under the U.S. tax treaty.
Thanks, David. I'll take over now and further confuse everybody talking about states and nexus. And like David said, those business activities, they're really important to understand what a foreign company is doing in the U.S. The nature of your business activities really dictate the extent of tax you may be subject to by different state and local governments. The first concept I'd like to talk about on the slide, the overarching concept, is this theory of nexus. It's very similar to the permanent establishment concept for federal income tax, but this is for state and local taxes. Nexus really describes the amount and degree of a taxpayer's business activity that must be present in a state before it becomes subject to that state's taxing jurisdiction or power. So there has to be this definitive link, this connection between a state and the person, property, or transaction it seeks to tax. And that's been defined over the years from the 1950s forward in the US when it comes to income tax and sales and use taxes. And we don't make things easy down here. You can have different nexus standards for different types of taxes. It can be based on physical presence, some type of economic presence, or what we've seen states shifting to in recent years, something we call factor presence, which is a mix of minimum dollar thresholds for sales or property or payroll. All of these things can give you some type of nexus in a state. So I'll start off talking about sales and use tax, because that's near and dear to my heart. That's pretty much my specialty here at the firm, and an area I've been practicing in for 25 years now. And up until about 5, 6 years ago, sales and use tax nexus was pretty easy. If you had physical presence in a state, either employees, a facility that you were renting or owned, some type of inventory, that's really the only thing that created nexus for you in a state for sales and use tax purposes. Now, if you're a state tax authority, you're looking at, over the last 10, 15 years, this shift from, retail brick and mortar sales. You went to the store in your state and you bought something, you were charged sales tax, to consumers now buying large quantities of goods, whether businesses or individuals, over the internet. Obviously, between Amazon, eBay, Wayfair, Walmart, everyone has an online presence now, and it's very easy to buy from a company outside your border, outside your state. And with physical presence, a lot of times you weren't paying sales tax, didn't need to pay sales tax. The states were losing a lot of tax revenue. So this finally came to a boiling point in 2018 when the state of South Dakota basically audited Wayfair. I think everyone knows who Wayfair is, the large online retailer. They sell furniture and home goods and whatnot. Audited them, and it advanced quickly to the South Dakota Supreme Court and on to the US Supreme Court, where the court decided that this physical presence standard that they, in fact, ruled on in 1992 was really no longer it was unsound. It was incorrect. It was not the right standard that you should be using to determine sales and use tax nexus. So really the court created a new filing requirement based on South Dakota's judgment here. South Dakota said, look, Wayfair, you have over $100,000 of sales in our state to customers in our state, or you're making more than 200 sales, 200 transactions to a customer in our state, then you have nexus for our sales and use tax. This applied to what we call this category of sellers called remote sellers. And a remote seller is generally any business that sells tangible personal property or services for delivery into a state using the internet, mail order, or telephone without having any physical presence. Because if you have physical presence, you have nexus for sales and use tax. That's still on the table today. That hasn't gone away. But the states, I like to say, added another arrow to their quiver with this economic presence. So, and to make clear here, a lot of our clients, a lot of businesses we talk to tell me, well, Tom, I don't sell online. I'm not a retailer. I sell machinery or equipment. My customers don't buy that from me online. That doesn't matter. You're still a remote seller. If you don't have physical presence, regardless of how you sell, you're a remote seller in other states. So, of course, like David said earlier, we are dealing with 50 different countries who do not impose uniform sales thresholds. They don't have the same effective dates. The effective dates of a lot of these economic nexus or Wayfair thresholds started in June of 2018 after this court case was decided, to most recently January 1st of 2023 when Missouri finally got on board. So you have a lot of different periods here. You have different, like I said, effective dates when these states came online with these thresholds. You have different time periods. You have to look back to see if your sales exceed the threshold. Either a prior year, current year, the prior 12 months. It's different depending on the state, as well as the types of transactions. Some states will say all your sales, your gross sales, count towards the threshold. Some states will say your retail sales, which means all your sales except sales for resale. So, those types of sales you're selling to a distributor or a third party who's going to resell it. And then a few states also just say, look, your taxable sales. Whatever's subject to tax in our state, that's what counts towards the threshold. And if you click on the link there for the Wayfair thresholds, that's our most recent guidance on all 50 states as to what level of sales will create nexus for sales and use tax purposes. The most general concept that we see is $100,000 in sales dollars or 200 separate transactions. That's seemingly going away as a lot of states are removing the or 200 sales because you're generating a lot of additional taxpayers with small volumes. that's really a burden for a lot of these states. That's going away. Now, at the same time, you might be saying, okay, well, Tom, I just sell on Amazon.com, right? Or I just sell on a marketplace like Walmart. I don't have my own website making sales. Well, unfortunately, there's different rules for these marketplace facilitator type sales. Every state basically says the marketplace is responsible for collecting sales tax. So you may be able to avoid the sales tax filing requirement if you don't make your own online sales, but you will have other issues because you're going to have inventory in some of these states in an Amazon warehouse, perhaps. And we'll talk about that moving forward. So every state, unfortunately, like I said, has its own rules and regulations regarding the taxability of their sales too. So once you figure out nexus, you then also have to look at whether or not your products and services are taxable. And lately, the most recent count is there's over 13,000 sales tax jurisdictions in the US. Most states will allow you to file a return that incorporates the state tax and the local tax on one filing. But there are some states like Colorado and Alabama, Louisiana, Alaska, that allow their own localities to collect and administer their own taxes. So I have one client, we file a Colorado return for them, and then we file like 25 other local returns because they're selling into different jurisdictions. And I think it's important that, even if maybe you're not hitting these thresholds, maybe you do sell for resale or you're selling exempt goods, into these states, that you document those sales with your resale and other exempt certificates. We've done, I think, webinars in the past, Carolyn, just on that from sales and use tax perspective on gathering those certificates.
Yep, and those are all saved on our YouTube channel. Also to the Wayfair thresholds that Tom mentioned here, they are also in our handout section, so you can also grab them there, and I'll email them this afternoon.
Perfect. So that's sales tax in a nutshell. It can be very complex. We do a lot of work for our clients, helping them determine nexus, helping them determine their filing requirements, registering, filing the returns, and all that. So it's gotten to be a very, very robust process since Wayfair was determined by the U.S. Supreme Court in 2018. Now, for income tax, it's a little bit different. Income tax, you can have nexus for a variety of reasons, whether it's physical presence, if you have employees, you have remote workers, facilities, inventory in a state, that could be enough to create nexus for an income tax filing obligation. Physical presence is not needed though. I mean, you'll see here with the economic nexus and factor presence that just being in a state, that the states have other ways to get you if you're not there. Economic nexus has been a concept, like we said sales tax that came around in 2018. Economic nexus has been argued for income tax since at least the 1980s. There's a big court case in 1993 in South Carolina that really promulgated more states to pass these economic nexus laws for income tax. A lot of these issues have been litigated in state courts. So typically, if you have a significant economic presence in a state, or you're purposefully directing your business activities to take advantage of a state's market, then you could have an economic nexus. But for the most part, these laws that have been passed by statute in states are limited to like the licensing intangibles such as trademarks, financial institutions, credit card companies. They have a lot of issues with the economic nexus. So that's what we typically see there. Kind of an offshoot of the economic nexus has come about in recent years, what we call factor presence. So a lot of states are moving to this factor presence standard where you would be considering doing business in their jurisdiction if you had a certain threshold, back to the thresholds again, like we have for sales tax, of property, payroll, or sales. Most commonly we see like it's a $50,000 or we adjust it, it's typically adjusted every year for inflation and whatnot. 50,000 of property or payroll, sales of 500,000, or 25% of all your stuff into one state. So there's about 14, 15 states that have these thresholds. Now, you might be saying, well, hey, I have this, I'm in trouble in this state, but states are still limited as to how they can impose tax on businesses by federal law. So we have this federal limitation that's been around since the 1950s that was passed by Congress that limits states of power to impose their net income tax on multi-state businesses engaged in interstate commerce. This public law 86272, or PL 86272 we call, has been around, was enacted by Congress in 1959 to provide multi-state corporations a safe harbor from the imposition of state income tax. However, it's limited. And as technology has advanced and the nature of what we sell has advanced, it's becoming more and more constricted as to who's protected. And the states have been hammering on this for years, trying to limit PL 86272 as much as they can. But if all you do in a state is solicit orders of tangible personal property, and those orders are sent outside of the state, maybe back to Canada for approval, and the order is fulfilled or delivered from a point outside the state, then you would be protected by this PL 86272. So for income tax purposes, if you just have salesmen down here, salespersons in states making sales for TPP, tangible personal property, that does not include services, that does not include digital goods or services, they're sending that order back to Canada where the head honchos are approving it and the product's being shipped from Canada or from outside that particular state, then you're subject, you have this PL 86272 protection. Some states may not offer this to foreign sellers, like California, for example, by law, it only applies to interstate commerce. It doesn't apply to foreign to the states commerce, but the Multi-State Tax Commission and the government kind of encourage states to provide equal treatment between states and foreign countries in this case. And like I said, PL 86272 is being eroded. Most recently, this Multi-State Tax Commission came out with a number of rules that really applied to e-commerce companies a few years ago that really started looking at electronic activities and whether that exceeds the protection of PL 86272. California and New York are two of the first states to really enact this type of legislation. However, it's being challenged. It's already being challenged in California, and I would expect more businesses to challenge that as well. And like I said, there's a lot of traps with this PL 86272. You can have taxes that aren't subject to net income. Reminder, PL 86272 only covers net income tax. It doesn't cover a minimum tax or an alternative base tax. So you have states that have gross receipts taxes like Ohio. Ohio imposes what we call the commercial activities tax, or the CAT. And several other states have these gross receipts taxes. They're not measured by net income. They're measured by your top line revenue with very few exemptions or deductions from that. And it applies a broad-based tax with a minimum rate that applies to most companies selling into their state. Texas has the margin tax or franchise tax. Washington's another popular one, their business and occupation tax, their B&O practically applies to everybody. They don't have a state income tax, they just have this B&O tax. And then also you have the California $800 fixed minimum tax that a lot of companies are subject to. Now, these liabilities can be minimal, but if you're not filing, you're not paying them, they add up over the years. If you start tacking on interest and penalties, and if you've never filed in a state before, there's no statute of limitations. So most states have a statute of limitations that allows them only to go back 3 or 4 years. However, if you've never filed, there is no statute. So they can go back 7, 8, 10 years, depending on how long you've done business in that jurisdiction, and impose that tax, impose interest and penalties if they catch you, if they audit you, they send you a nexus questionnaire. So have to be very careful of these types of taxes. And then finally, just some other issues that we typically see as businesses expand into the U.S. Business registration and license fees are a critical thing. There's really 2 sets of them. You have your tax registration, if you have to register for a sales tax or withholding or property tax. But there's also Secretary of State registrations where you're filing to be authorized to do business in that state. Now that's something we typically advise our clients to speak to their attorneys about. It's more of a legal issue. That's something you have to, most states allow exemptions for people who are just selling tangible personal property into the state, but maybe you're providing services or construction or some type of professional service. You may have to register with the Secretary of State to be licensed to do business there. Again, the gross receipts tax, as I mentioned, payroll taxes. If you have employees living in the U.S., they're subject to withholding if the state imposes an income tax. Well, plus, you're going to have a plethora of unemployment and workers' comp and family leave filings with the state departments of labor that you're going to have to look into. We have some states that impose property taxes. Most states, every state pretty much imposes a real property tax on a factory or a place that you may own. But there's also tangible personal property taxes, largely in the southeast of the U.S., where if you have inventory, you have equipment in states, those might be subject to a property tax. And then, like I said, we have cities and localities, districts, they may have filing requirements as well that you need to consider if you have physical locations in the U.S. So, hate to always rain on everyone's parade, but state and local taxes can be at times more complicated and more worrisome, more cost you more liability than even the federal income tax.
Thanks, Tom. Before I get to the expanding in other countries real quick, that's, you hear all this and you're 45 minutes in and you're saying to yourself, what did I get myself into here? What am I doing? Well, we can help with that. I mean, we can, if you have good data, and I think that's one of the big keys, especially to be able to tell us where your sales in the U.S. are, your sales by state, by destination of your product, or where the service is being rendered, or where the benefit of the service is being received. We can look at that for a 3-year period, a 4-year period, a 5-year period, and analyze it, and then really help to quantify that for you going backwards. To help you mitigate your risk. We can see what options might be on the table if there's a state you have to file in or a couple states you need to file in to see if they have any voluntary disclosure or amnesty programs that we can get you caught up with. And then, then we can, plan going forward to see if it still makes sense for you to be operating in the U.S. in that same manner, or if it really does make sense to, incorporate a separate U.S. company. And then moving on to expanding internationally, I just want to touch on this real quick. because we do get asked this. So the process is very much the same, the same process that you would really employ to come to the US. Figuring out the W's about who, what, when, where, and how it's all happening, to have that important. And then we do have some contacts in other countries as well, so getting that local professional advice about what the requirements are on the ground in that country. Canada has tax treaties with 84 countries. The website at the bottom of the slide is the OECD. That has really good high-level information, but it's a good place to start if you're planning outside the borders. Not part of this presentation today, but sometimes if the U.S. does have some newer export incentives. So if you're going to have a U.S. entity and you're also going to have to be exporting outside North America, there may be a reason to run that through your U.S. subsidiary company.
Great, thank you guys. I totally agree with David's comments there. I think it's staying close to your advisors. Don't let yourself get overwhelmed. The US is a great market to enter into, but we just want to fair warn you, not scare you, but fair warn you, that there's some things to stay connected to, be aware of, and again, stick close to your advisors because they're there to help you and help navigate all of this to be like, you're good in this area, okay, this is what we need to do in this state, and really be able to break it down and partner with you.
Yeah, I mean, it sounds overwhelming, but I think with proper planning and communication, I mean, we see it work all the time for Canadian and other foreign sellers. It's just, knowing this stuff up front, knowing where you're making sales, how are you making sales? If you're selling online, are you using Shopify? Are you selling through Amazon or one of the marketplaces? We have the right data, the data is good, we can help determine that and then help you with the compliance moving forward. So it's not as complicated as it sounds.
Yeah, we often say don't let the tax part of it get in the way of a good opportunity. Don't let the tax tail wag the dog here. If your business is a good opportunity in the US, take it, and if we do everything proactively, then we can help you manage that risk.
Mm-hmm.
Yeah, record keeping is, a key word I keep hearing too, so that'll make your life easier. So we do have time for questions. If you do want to enter anything into the question box, we'll get those answered for you. Also wanted to provide the contact information for our experts again today, if you want to have a one-on-one conversation with them and dive specifically into a situation you're faced with. As you're doing that, I'll just kind of give a couple other updates. Again, you will have the webinar survey sent to you right after the presentation. If you can give us some feedback on the webinar today. Again, if you have any questions for our experts or if you would like to meet with them one-on-one. Also, too, just want to point out our next webinar is going to be February 8th. We'll be discussing Destination USA. Does your company provide freight delivery services for US bound goods or delivery of product to US customers in company-owned vehicles? Join us for this informational session on the federal and state tax considerations that may impact your business. David, I do have one question that came in earlier on in the presentation. You talked about that 183 days. Does that include trips to the US only for business, or does that include your personal trips down here? You want to go to somewhere warm and sunny or go visit Disney or whatever? How does that break out?
Yeah, Carolyn. So the 183 days for the business is that rolling 12-month period, and that is really just business days in the U.S. Now, sometimes that's difficult if you're a sole proprietor or you're coming down to mixed business and leisure. You probably need to keep track of those days that you're truly working and those that you might be here on vacation or you send your vacation after the fact. That truly is for the business. We didn't get into it today, but on the employee side of things, again, everything else being the same, federal and state would apply to potentially to your employees as well. That test is going to be contingent upon whether your business has potentially a permanent establishment, but that test is on, does mix business days and leisure days. So if you're here for 183 days personally, you probably want to talk to us. Then there was one more question that came in. The question here is, what if my business is selling my product into the US, but we're contracting out for installation and training and commissioning? That's a great question. So in that situation, federally speaking, you would not still have a permanent establishment. It would, of course, recommend a treaty-based return filing. But unfortunately, for state purposes, that's really one thing under Nexus that that would give your company Nexus, especially in the case of you charging for that installation, training, commissioning, those types of things. Even if you're working with a third party to do it, it will give you a state Nexus. And then, like I said, I do have a number of companies, one that sells big shelving apparatus that are in manufacturing setting. They sell everything into the US. They contract out to third parties for delivery and installation. And we do file that federal treaty-based return for them to protect them. They do file in about 5 or 6 states. And some of those states are covered under the tax treaty. Other ones are not. So they do pay some, mostly nominal state taxes, but it can vary state on state. And I know we didn't really get into it today, but you might think, oh, well, how many different taxes do I have to pay? How many different layers of tax do I have to pay? And state taxation is a little bit different. So we take what would be taxable on a federal basis, whether you have to pay it or not, may depend on the treaty, and then we would divide it up. We do what's called apportioning income. And so most states use the sales factor at this point. So they would say, okay, if I'm filing in the state of California, what percentage of my sales were to California customers? If 10% of your sales were to California customers, 10% of your profits would be taxable in California. And as Tom mentioned earlier with those gross receipts-based taxes, one thing I did want to point out there too was, it doesn't matter whether you're profitable or not, right? So you file it, you check those thresholds, and I know Ohio's is going up, but Washington's is pretty low. But if you're over 100,000 of sales into Washington, and your business is in startup or that didn't have a good year profitable, you're still paying that tax, which isn't passed along to the customer. You may have to do so directly somehow, but or build it into your costing. But it is a cost of doing business.
Great. Thank you. Again, it was a lot of great information you both shared today. Thank you, David and Tom. And reach out to us if you have any questions. And we will see you on February 8th for our next webinar. Have a good day, everybody.
Thank you.
Thank you.